Hello and welcome to your FMLS Market Intel Report. I'm Leslie Appleton Young, Chief Economist at FMLS. The sun is out, flowers are blooming, and the spring home buying season is upon us. Let's unpack what to expect this spring. How quickly things can change, especially in the mortgage market. Last episode, I talked about the slight drop in mortgage rates in the week since the 7.04% high in mid-January. But since the beginning of March, we've seen the largest weekly decline in almost 6 months. The average 30-year fixed-rate mortgage fell to 6.63%, a 13 basis point drop in 1 week and a full 41 basis points below mid-January. What does this mean? Well, lower rates improve housing affordability and increase purchasing power. This incentivizes people to make a move to buy or sell now. For example, if a buyer has a $400,000 loan with a 10% down payment, this translates into a $100 reduction in the monthly mortgage payment. This is a great talking point for those fence-sitter buyers to get back into the market. Now let's talk some stats. In the 4-week period ending March 1st, the FMLS market area saw a 5.9% drop in pending sales. I'll be watching this number very carefully in the next few weeks to see how buyers respond to the drop in rates. Market Stats also reported a 12.4% increase in new listings and a 6.4% increase in coming soons. This tells us that buyers have an expanding number of homes to look at, and it's another incentive to come back into the market now. Mortgage rates are influenced by a variety of factors: bond market investors' expectations for future inflation, global demand for U.S. Treasuries, and the Federal Reserve's interest rate policy decisions. Currently, the bond market is very concerned by recent signs that the economy may be slowing. The February jobs report at 151,000 new jobs came in below expectations, and the unemployment rate ticked up slightly to 4.1%. In addition, investors are attempting to process the impact of tariffs as reflected in the volatility of the stock market. We have also continued to see erosion in consumer confidence, with the latest reading from the Conference Board registering a 7-point drop. This is the biggest decline since August 2021. Consumers are worried about future business conditions, employment prospects, and future income. So it's no wonder that investors are seeing bonds as a safe haven in uncertain times. So while the bond market jitters are a positive for the housing market today, the longer-term outlook is clouded by a host of known unknowns. A weaker economy will increase the likelihood that the Federal Reserve will actually cut mortgage rates. However, a burst of inflation will do the opposite. Only time will tell. In addition to lower rates, the mandates to return to the office full-time may also drive housing demand this year. Companies including Amazon, AT&T, JP Morgan Chase, Dell, and Tesla are just a few of the firms that are expecting their people to be back in the office in 2025. Under the direction of Dr. Lisa Sturdivant, Bright MLS launched a nationwide survey at the end of last year asking homeowners how these mandates would affect them. Fully 25% of remote workers said that they would probably or definitely need to move if mandated to work in the office full-time. What does this mean for Atlanta? At last month's Economic Outlook Conference, the president and CFO of the Atlanta Chamber, Katie Kirkpatrick, noted that 70% of the Fortune 500 companies actually have a footprint in Atlanta. As the 6th largest MSA in the nation, Atlanta is a top growth center for business relocation. And the number one question she gets from companies looking to come to Atlanta is this: where will my employees live and can they afford it? As ever, it's all about housing. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. Visit firstmls.com/intel to access the most current market statistics. They are updated weekly. For FMLS Market Intel, this is Leslie Appleton Young. See you next time.